Hello, everyone. Thank you so much for joining us today. We will start here momentarily. As always, give everyone some time to log on and get their live stream set up and loaded. My name is Dominique, and I'm the Investor Relations Manager here at Greenleaf. I have the Greenleaf team here with us today, Managing Partner Dave Codre, and helping me drive this live stream, we have Natalie King. Again, folks, we're going to start here momentarily, so just bear with us, and we will begin shortly. Thank you, everybody.
Yeah, 9 to 3. So I'm excited, ready to get my hands dirty at the farm.
How many people signed up?
Like 25 so far.
That's a lot of people.
Yeah, we're gonna. We have like stage building for the outdoor classroom. We have a bird's nest that we're doing.
You're all gonna get to see this pig. This thing is like the size of a bus. When Christopher sent it over, she's like, "Oh, we got this pig." I'm like, "Where? Where does it live? Where did it even come from?" It's like an alien landed in the middle of Kirkwood.
Yeah, and then the farm stand should be really cool to see.
Someone needs to get one of those two things around.
Do a photo shoot with the pig.
Yeah, the farm stand, because they got refrigeration in there, and it's pretty cool.
Yeah.
Yeah, it's definitely come a long way. We should send out the video of what it looked like ahead of time,
That would be really good.
because it was lots of Georgia kudzu.
Mm-hmm. And then what we're going to eat there is going to be stuff from the farm. So that's going to be fun for lunch.
So exciting. Well, all right. Hi, everyone. For those who just logged on, my name is Dominique, and I am the Investor Relations Manager here at Greenleaf. I have the rest of the team here with us today. Today, we will be sharing a property update on Oak Hollow Apartments. First and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week, highlighting a portion of our business. Private events being more interactive, while live streams are open to the public. We first want to provide some rules of engagement for you today. First, you do have the option to change your presentation view. Feel free to switch your attendee presentation mode to speaker spotlight, or click and drag to make the presentation and our panelists bigger or smaller. There will be a question and answer portion at the end of this presentation, but you do not need to wait until the end to submit any questions you may have. You can click the Q&A button located at the bottom of your screen and submit any questions, and our team will be sure to answer them. This is a friendly reminder that this live stream is recorded and will be shared via email by the end of the week this week. We also want to provide a brief overview of what to expect this afternoon. We just went over some rules of engagement. We'll jump into Oak Hollow's property update along with a strategy update, and then we will close with the Q&A portion that I previously just mentioned. So without further ado, I will pass it over to Dave Codre and begin our discussion on Oak Hollow Apartments.
Okay, great. Thank you very much, Dominique. And thank you for everyone for tuning in here and listening to kind of where we're at with Oak Hollow, how we got here and where we're going. So just a quick recap on kind of the history of this deal. We purchased it in January of 2019. We purchased it in the future. In 2019 of January, bought this thing for $3.6 million, which is roughly $50,000 a unit. Our rents at the time were around $640, and we purchased it with CBRE alone there. So go forward 1 year, got to January 2020. While we're doing some of our renovation work, our occupancy dropped to roughly 20%. And then the updates we were sending out at that time were more like building by building as we were making progress. Then COVID happened in the middle of January of 2021. Now we're in the deal 2 years. We've finally completed lots of renovation work. There was a lot more here than we expected. We had situations where, we go into a bathroom and all of our maintenance guys can attest to this that were there. Like, you've got a plumbing pipe that kind of lined up like this. Like, not quite happening. So that obviously didn't work very well, and removed a couple layers of interior ceilings that were mismanaged over the years to get this thing back and operating. So overall, we spent out $1.1 million. Is not what we were planning to do there. We did not think it needed that much work. required a good amount of extra participation from the GP side. And overall, our basis now is about $75,000 a unit, or $5.3 million. Coming from January, get into June of 2021, we're now at a point where we're actually starting to produce positive cash flow, which is great. We're 93% occupied at this deal, and our rents are about $830 a unit. All the new leases we're signing to are over that $830, so we're more looking at like the $850, $900 range for our rents. We have 41 units that are fully renovated that we went in and did everything on. 29 units that are, as I mentioned, we fixed some of the plumbing pipes and fixed the ceilings, but they're pretty much just classic style units with a couple upgrades here and there. So this last box, we engaged Cushman & Wakefield about 6 months ago to really start looking at what does the market look like and give us an opinion of value. We use this value for two things. One, to look at what can we refinance, what proceeds would be there, or what could we sell the asset for? And that's what we're here today to talk about, is go through those two things. If there's any questions on the history that I just went over, I know that was relatively quick. You can put that in the Q&A part, and we'll touch base on that at the end if there's something that I missed or there's something that wasn't clear. So we look at Cushman & Wakefield's offer, not offer, but their opinion of value came back around $95,000. So what does our capital stack look like today? When we look at where we're at, we take that $95,000 mark, that puts us about $6.6 million of market value. Right now we have $2.3 million in remaining equity. We've got just under $2.4 million in debt in the GP loan. So that means there's $1.475 million of current equity in the deal, just over $20,000 a unit. So that's really the room that we have to work with in our decisions on refinancing or selling the asset. So going into holding the asset is okay, what does this look like if we were to hold Oak Hollow? Our current loan is at 4.8%. And on a lot of these webinars we've done over the past couple weeks here, when we're talking about refinances, we're seeing rates in the 3.2 to 3.5% range. That's where stable assets are getting us. And when I mean stable, that means something where we're pulling out, a 60 to 70% loan to value, and we have a good track record of performance. As we go higher leverage or we go with less track record, our rates are normally going up. But right here, we see over the past 6 months, we've generated about $60,000 in net income. Now that annualizes $120,000 that we could then apply to a debt service number. But the last 2 months, it's gotten better. From 3 months to 2 months, we did $38,000 in the last 2 months alone, which is what we're underwriting things on right now, annualized to $228,000 of net income that we could use for a loan. So that T2 can support about $3.4 million in debt, maintaining a debt service coverage ratio of 1.25. And essentially what that means is we have to earn 1.25 times what our total mortgage payment would be, principal and interest combined. That is really where our limitations are when we talk about any kind of refinance or any kind of loan, is that it's got to cover the loan payment, which isn't a bad thing. It seems like a good rule to me that the banks have. So when we look at a refinance, our goals in a refinance, these are always the same. We have a refinance model we run on every time we're looking to do one of these. We want to make sure we hit on these points, right? So we want to be able to return investor capital. We want to be able to improve the return on the deployed equity. So by returning investor capital, we can then, the yield of the asset with equity in it is improved. We want to create a pathway to get to this overall upside improvement. We've done a lot of deals where we have 100% cash out. That's ideal, that's best case, but there's got to be some form of cash out in this to improve that upside. We want to improve our debt coverage. So we're able to reduce interest rates, which helps improve our debt coverage ratios. We want to have a max prepayment of 5%. Typically, by doing our refinances, we get into a step down basis on prepayments over the length of a loan, whether that loan is a 5, a 7, or a 10-year loan. We're looking at how do we have step down prepayments, so we're not in a yield maintenance situation, or we're not in defeasance or any of these other kind of fancier calculations of managing our interest rate risk. And the last part, Josh and I enjoy if we get to remove personal recourse. That's always a goal on there. So put that one on there. We like when that happens. So if we look at a projected refinance analysis, so going back to that $6.65 million value, a new loan would be $3.4 million, with what we can afford right now with our net income. So we have our old loan and the GP part, we have some closing costs, and ultimately it only frees up about $387,000 in cash. So we would then try and what's the best use of this $387,000? We have about $90,000 in deferred CapEx. We know going into this deal that there was, we know going into right now that there's still some work to do. The bulk of that is around parking lot repairs. We have some foundational work on buildings, some landscaping. When we do landscaping upgrades, we're really looking to try and reduce our operating costs. So it's like, how can we better position the outside of these buildings to be easier to maintain? And the parking lot, that ties into everything from cracked curbs to ADA compliance and those aspects that we have to manage on an asset, anything that we're going to hold long term. We obviously have to fix those things and properly maintain the asset. So that's about $90,000 worth of work. But then that leaves us with this big chunk of existing equity and owed preferred returns. As investors in this deal, we have not made any distributions. So we have $457,000 of preferred returns that are accrued. And right now we're really only accruing more as we're not making distributions. So any money we do have has got to go to those first. So we'd have about 90 grand held back for these capital improvements, and then the 300 that we'd apply to owed press under this scenario. So that's not, when we're looking at a refinance, that's not ideal. Those aren't really the numbers we want to see. So if we look at the sale aspect on this deal, here we've got, again, our market value of 6.6, our remaining equity debt in the GP part, we have 1.475 million that would be available for basically the profits in the deal. Now that's going to go back to pref, and then we'll have profits of just over $1 million. So if we're to execute a sale at the current market, where we see things with our broker opinion of value, we're going to generate roughly a 16.7% IRR over that 2.5-year hold period and a 1.5 equity multiple. So we think about that. I know in a lot of deals we've had some big hits, and they've been awesome. This is still a very, very healthy return. We're happy with this. It's not a grand slam return, but it's a good single or double territory if we were to sell. So our comparison here, we want to dive into what does it look like when we're doing a refinance or a sale. So we touched on those 6 points from a refinance that we really want to be hitting. So the pros on the refinance, well, if we're able to generate more cash flow, we can raise rents. We'll have this stable loan long-term. Our debt coverage is improved. Max prepayment is under 5%, and there is no personal recourse. So it does give us an even longer-term loan that we could fix things in for and get that interest rate in the low to mid 3s. The cons on this, it does not enable us to return any of your investor capital. We're able to pay down some pref, but no real return of capital. So we don't improve our leverage ratios there. It does not do anything to improve our return on equity deployed. We still have the same amount of equity out there, and it doesn't, we don't get to an overall upside position anytime faster. So that's kind of the con on the refinance. On the sale, the pros of this are we're going to generate $1.5 million of cash right now. Gives us about $3.8 million that we could roll into a 1031, and obviously avoid current capital gains on that, and then also work to position an asset that can pay current yield. We're always looking to generate current cash flow. Value is nice, but we really want current cash flow. The cons of this, of doing a sale is, we're exiting another residential property, and we are seeing rates, as I mentioned, rates are growing. So you would miss out on participating in that rental growth that we see. So that's where we're at on comparing the refinance in the sale. So overall, when we look at these options, we really think the sale is the best option to go with. From a comparison standpoint, we can take that $1.5 million right now and our current equity of $2.3 million. So we have almost $3.8 million. Most of the commercial assets that we're finding right now, we can easily yield 6%. That's kind of at a bare minimum. So that would be in the range of like $200,000 to $250,000 of current cash flow that we could produce in a commercial asset. While on the apartment side, even post refinance, we're only generating about $20,000 to $30,000 of cash flow off of this deal. So that would be, that's a pure dollar amount. That's a lot less. It's about 10x the cash flow if we deploy this cash into a commercial asset. That's really why we see the sale as the best option, because we know we can reposition the dollars and produce current yield at a return of about 10x what we're currently doing in the refi scenario. If we don't do the refi and we don't do the sale, we're kind of in a situation of no cash flow. So that's, although that is an option, that's not really one that we want to pursue because it's not producing any cash flow. So again, refinance, maybe 20, 30 grand a year in cash flow, or sale, realize that equity and look for an option that we can do in the $200,000 to $250,000 a year in cash flow distributions. So that's where we're at right now. We see this sale proceeding with Cushman & Wakefield, who did the opinion of value, as our best option. And we're going to bring Natalie in here now. We're going to go through some Q&A. I'm sure there's lots of questions around how we get to these situations and what we do from here, and what the future holds for the Oak Hollow investment.
Thank you, Dave, and thank you to everyone who submitted questions. The first question we have is, could we hold and make more money in the future on the sale? And if so, why don't we hold?
Yeah, I mean, we can always hold, and it's kind of like hope that we make more money in the future on it. To really get to a point where we're going to make somewhere in the $200,000 range, we've got to increase our rental rates by $200 to $300 a unit. So that means we're going to have to do another round of improvements, and we're going to have to do another full turn, which we don't really have capital to do, and over that time frame, there's no distribution. So we'd be looking at another 2 years of really accruing prefs, and maybe we get values to 110 or 115 a door. Two of the recent transactions we had, Ridgewood, we sold at 115,000 a door. That was a deal in Lawrenceville. We bought it. It was deal number 28. So we bought it a while ago, but there the rents are a little bit better. So maybe we could get to 115 a door, but that's out 2 years with a lot more risk, in our opinion.
Okay. Next question. What is us moving from a multifamily asset to a medical asset telling us about the market or Greenleaf strategy?
Yeah, that's a great question. Strategy-wise, so we've been in business since 2008, and we've gone through lots of different scenarios. Oh, never mind. I mean, we're doing an investment strategy review in about 2 months as well. But there's all these different scenarios that we identify. We're trying to find yielding assets, and whether it's medical or commercial or one of those, we're able to buy assets in that space around a 7% cap rate and still get this 3% debt that's out there. While on the apartment side, the assets that we've sold at a 3.5 cap rate. At that rate, we just don't really have a way that we can produce cash flow on that asset. That business model is more buy, have no cash flow, try and get some rental rates and sell on a new value. That's not our business strategy. So that's why we're, other assets that we have done, we've shifted to where can we deploy our strategy of value improvement, operational efficiency to generate long-term cash flow.
Wonderful. Well, those are all the questions we have. Again, we thank everyone for submitting your questions today. And of course, thanks to Dave for sharing these Oak Hollow updates with us. As we wrap this up, just a friendly reminder of some of our upcoming dates. Dominique's going to put these on the screen for us. So we plan to sign our Oak Hollow listing package by the end of July. And then by the end of August, we expect to have our buyers selected and the 1031 options for the partnership. And we will host another live stream for this update with a target close date by the end of November. And then we have some of our upcoming live stream here on the right. On the 22nd, we have a new deal overview for Dollar General Statesville. On August 5th, we have our end of quarter reviews for residential and commercial. On the 19th, we have our Park Hill refinance. And on the 26th, we have the Greenleaf investment strategy overview Dave was talking about. So don't forget to check out our upcoming Greenleaf Connect YouTube channel for all of our recorded live streams, with this recording being made available by the end of the week. And this concludes our Oak Hollow broadcast. We certainly appreciate you joining us today, and we look forward to having you join us on our upcoming live streams. Thanks again, and enjoy your day.
All right, thanks everyone. Have a good afternoon. Send out just updates too on past 1031s. I keep those too.